Okay, so picture this. It's tax season. Your W-2 arrives, you tear it open, and your eyes go straight to box one, wages, tips, other compensation. And then you look again. That number, it seems way too high. I mean, way higher than your actual salary. And for a second, your heart just drops.
Your mind starts racing, right? You're thinking, oh no, did my company mess this up? Is this going to be a nightmare to fix? It's a totally stressful moment. But take a deep breath. In most cases, that number is probably right. The reason for it, though, is kind of hidden in plain sight.
Yep, that's the one. If you exercised non-qualified stock options, we call them NSOs, at any point last year, you just found your culprit. This isn't a mistake. It's just a really surprising and honestly pretty confusing part of how NSOs work. So let's break this down. The easiest way to get your head around this is to stop thinking of it as a tax problem and start thinking of it as a hidden paycheck. See, when you exercise those NSOs, the IRS looks at that and says, hey, your company just gave you something really valuable. It's a form of compensation, even if no actual cash hit your bank account that day. And this hidden paycheck has a name. It's called the bargain element. It's basically the profit you made on paper the very instant you exercised. Think about it. There's the price the stock is actually worth on the market. That's the fair market value. And then there's the super low discounted price you got to pay for it, your strike price. That gap between the two, that's the bargain element. And here is the absolute key to understanding all of this. The IRS couldn't care less that you got stock instead of cash. They see that bargain element, that on-paper profit, and they treat it exactly like your company handed you a big fat cash bonus for that same amount. And what happens to bonuses? They get taxed, plain and simple. So how does this bonus actually become that big scary number on your W-2? Well, the math is actually super straightforward. Let's walk through the 3 simple steps. So it's a quick 3-step process. First, you figure out your profit for just one share. Easy enough. Then you multiply that by how many shares you exercised. That gives you your total bargain element. And for the grand finale, you just add that number to your regular salary. That's it. That's the number that goes in box 1. Let's run some actual numbers so this really clicks. Let's say you exercised 1,000 shares. On that day, the stock was trading at $55 a share, but your special strike price was only $5. Well, that's a $50 profit on every single share. Multiply that $50 by your 1,000 shares, and bam, you've got a bargain element of $50,000. Now, let's start with your regular salary. We'll say for the year it was $150,000. This is the number you expect to see, the number you think of as your income. It's kind of the baseline for your W-2. But now we have to add in that non-cash bonus. So we take the $50,000 bargain element that we just figured out. This is that hidden income that makes the final number feel so much bigger. And here's the aha moment. You add your $150 salary to your $50,000 of NSO income, and what do you get? $200,000. That is the number your company has to report to the IRS in box 1, and that is the amount you're on the hook for federal, state, and payroll taxes on. You know, this brings up a really practical question. If that $50,000 wasn't actually cash in your pocket, how in the world did your company withhold taxes on it? I mean, they can't just slice off a piece of a stock certificate and mail it to the IRS, right? Well, they've got a few ways to handle it. They might ask you to just write a check for the tax amount, or they might take it all out of your next paycheck, which can be a huge shock. But the most common way, by far, is something called a sell to cover. Basically, your broker instantly and automatically sells just enough of your new shares to pay the tax bill. The cash goes to the government, and you keep the rest of the shares. Now, you might be thinking, hold on, I've heard that exercising options isn't always taxed like this. And you're not wrong. This whole W-2 surprise is very specific to non-qualified stock options. It's actually the biggest difference between NSOs and their slightly more complicated cousins, incentive stock options, or ISOs. So here's the bottom line. With NSOs, that bargain element is income. It goes on your W-2, it's pretty straightforward. With ISOs, it's not considered regular income at exercise. It does not show up on your W-2. Instead, it gets tied up in this other, much more complex system called the Alternative Minimum Tax, or AMT. So if you see that big jump in your W-2 income, you can be 100% sure you're dealing with NSOs. All right, so we have walked through the mystery, we've done the math, and hopefully we've cleared up all the confusion. So let's just do a quick recap of the most important things to remember. Number one, that huge number on your W-2 is not a mistake. It's totally intentional. Number two, it's all because of the bargain element, which the IRS just sees as a bonus. Number three, this bonus gets stacked right on top of your salary, creating that new total in box one. And finally, number four, your company has to withhold taxes on it, and they probably did that through a sell to cover. Knowing this stuff is so important for planning ahead.
So, the mystery of the W-2 is solved. You can file your taxes feeling confident you know what's going on. But this really brings up a much bigger question, doesn't it? Now that you get the tax hit from your equity, how does that change your strategy for the future? What's your next move? Of course, just remember this is all for educational purposes. You should always talk to a qualified tax pro for advice on your own situation.